This interview is brought to you by Westbrook. Well, most of the attention in South Africa, when you look outside the borders, has been into the United States in the recent election. But there was an equally important election that occurred in the United Kingdom. And we know many of the South Africans who are looking for offshore exposure or for some kind of rand hedge have been investing in the UK, and in particular in debt instruments offered by Westbrook. And James Lightbody is the head of real estate debt at Westbrook in the UK. You're a relatively recent arrival there, James. How long have you actually been in Britain for?
It adds up, kind of almost 5 years now. So yeah, it's been a few years.
And prior to that, I know you worked for RMB, you have a CFA, you've got a business science degree from UCT. Have you been focusing in the real estate area?
Yes, that's right. When I was at RMB, I was in the real estate team, which is quite relevant when you get to the big changes that happened in the market in the UK. That experience was key, but also just the structure of the market in South Africa is one where the banks dominate. They provide all the flexibility, whereas not quite the same in the UK. So, arguably you get a much better training in the South African banks than you would in the UK banks.
So help us understand how it is different.
Well, I guess the main difference, there were two sort of main differences. One is that the market structure of South Africa is one where the big banks, RMB, Investec, Standard Bank, tend to dominate lending, and they provide quite flexible solutions kind of up the capital structure. So they'll do senior debt, mezzanine, they'll kind of do full solutions for their clients. Whereas when you come to the UK, the result, much like the US, is that the high street banks, what they call them, the big banks like Barclays, etc., they tend to just do sort of very low risk, low LTV, loan to value lending, really due to the financial crisis, and they got sort of very hard restrictions on them. And so the sort of gap got filled by debt funds in the UK, like ourselves, which raise money from outside the banking system and then tend to provide the loans. So that's kind of the main difference, number one. And then number two, the biggest difference is that rates were 0% in the UK for pretty much 12 years, and then rapidly increased up to 5% around 2 years ago. And so kind of the market structure developed around having zero interest rates, having very low volatility. And so that has sort of a big impact on the market. Whereas South Africa, didn't have zero rates. Rates went up and down throughout that period. So kind of the market developed quite differently.
And it does open up an investment opportunity in the UK, which is absent in South Africa. As you've said, you've got all these new players coming into a market which in our country is dominated by the banks. But there's a private citizen, a private investor, you can get a slice of it.
Yeah, I think that's exactly right. And I think this is particularly relevant. I guess sort of one point to note is that the market is then also more competitive because the UK does have capital flows coming from all over. And, if you were looking in a zero rate environment, because rates were zero, rents tended to kind of tick up at a very low inflation rate. Building costs inflation was almost zero. You had a very, very stable market. You had almost no volatility in prices that just tended to tick up. So kind of all the lending was built under that assumption. And to talk to your point of opportunity, when rates went up very quickly, the lending market wasn't really adapted to that. They weren't used to that environment. They didn't kind of have that capital to do that. So if you're the likes of Westbrook, like ourselves, we really focused. We changed to kind of focus on that new paradigm. Our sort of entire risk philosophy, maybe biased from a South African heritage, kind of is built on assuming volatility is not zero. You're going to have changing prices. You kind of can't have a cookie cutter approach to risk. You really have to assess every single loan with a sort of very detailed framework. And that's how we've kind of had a competitive advantage in the UK.
The UK itself, and I mentioned this in conversation with someone the other day, is also had its seismic shifts on the political side. Everyone's looking at what happened with Donald Trump in the US, and sure, we're seeing on investment markets they are readjusting. But with the Labour Party coming in with its landslide and now a budget that well, high net worth individuals are not exactly enthralled about. Uh, there is a different approach, I guess, in the UK. How's that affecting your business?
Yeah, there are a couple of direct impacts from the budget, but mostly it's an indirect impact. So I'll kind of get to the direct impacts. If you look at the actual individual asset classes, for instance, operating real estate, which we term where they employ quite a few people, say the hospitality sector, like hotels, like pubs, they can be impacted from the increase in cost to employ people and things like that. But they've mostly come out and said they're just going to pass those costs back onto consumers. It's more of a sort of indirect question of, will this lead to inflation ticking up? Will the increased government spending lead to more inflation and higher interest rates for longer? So really the impact on the real estate market, which is very tied to interest rates, has been looking at kind of the 5 and 10-year UK sort of bonds and saying, well, how have they been impacted? And that the sort of yields on those have gone up, illustrating that they're expecting sort of rates to stay higher for longer. I think the broader impact is that is to that point I raised on kind of volatility, that you really have to be, you can't be just sort of assuming, zero rates and zero volatility in the market, because doing a cookie cutter approach to lending, you'll just kind of get unstuck in that world. So, we kind of focus on sort of a Westbrook philosophy around understanding risk, and we kind of more adapted to things like rates going up or down, things like that, because we stress all our assumptions on every single loan we do. So it's really the world of cookie cutter lending is on the way out, I think, and more sort of focused, specialized lending is on the way in.
And how would that affect those who've invested with you?
Yeah. So once again, if you were investing into a fund that just did a cookie cutter approach, they'll be struggling to adapt to the new world. Whereas on our portfolio, we made a big shift a couple of years ago to focus more on income-based lending. So lending on assets that were producing income. The reason for this, once again, if you look at the zero interest rate environment, the banks tended to dominate that market because values very rarely went down. Interest rates were zero. The sort of interest cover ratios are very high. That kind of all changed. And, some of the impacts from interest rates where inflation was higher, rents were higher, were positive for values. Other impacts, obviously high interest rates, were bad for values. So you really needed to assess kind of this impact and sort of not have a cookie cutter approach. We moved to income-based lending based on this volatility. There was a total gap in the market, whereas previously this wasn't needed. And now you've got shifting values. This really is needed. So that focus on income-based lending, which is more akin to something that happens in South Africa. The banks tend to focus on assets that are income producing. We're also doing that focus now. And we kind of think that's lower risk. There's inherently more liquidity in that market because buyers and sellers can look at the cash flows and say, okay, I'll price that, maybe differently, but they'll certainly be buying it. And, that was a big trend. So, the big changes have big opportunities, and we've been focusing on kind of those. And then absolutely, we had some older loans, which we tended to sort of back partners into those loans. And they were extremely proactive on making sure that the sort of borrowers were putting more equity into those loans or adjusting to the new paradigm rather than just sitting in our hands. So a combination of being very proactive on loans you have and then kind of adapting to the new environment, which is all kind of downstream of the way that Westbrook operate and kind of our risk philosophy of backing the right people, backing the right assets and really understanding the cash flows on every asset we lending on.
Yeah, being nimble. And it's interesting to hear that your South African heritage has actually played to your advantage in a country that hasn't been that turbulent, but does appear to be going into that situation at the moment.
Well, yeah, I guess it's all relative in a way. South Africa had, as I said, had rates that went up and down. You obviously had, values that went up and down. So it wasn't, it kind of grew up learning in that environment that was the normal way things could be. In the UK, folks had zero interest rates for 12 years. So they grew, the lenders there got used to the fact that nothing really changes very much. So, the shock from going from 0% to 5% is just like a gigantic shift in their mindset that a lot of lenders haven't been able to make. So it's really coming from a mindset of, we're quite used to, values going up and down and and cash flows changing and that kind of stuff, that we sort of inherently more adaptable, I guess, than the UK market, which was just blessed with no volatility for 12 years, even though that was maybe synthetic from central banks.
What about getting those reputable companies or lower risk companies to borrow from you? Is there any resistance, being a lot younger than most of the high street banks that they might have dealt with in the past?
Well, I guess there's sort of 2 points there. Number one is that the high street banks have retreated from that market because of the reason that, when rates are zero, the interest cover ratios were high, LTVs were low, and that actually has shifted as, rates have gone up. Their ratios aren't quite where they need to be. And particularly they tend to have, cookie cutter approaches. If the computer says no, they can't lend on those assets. So those kind of options have receded from the market, number one. And then number two, we've really been incredibly focused on that income-based lending part of the market. We tend to know a lot of the borrowers in that sector. We've delivered consistently over the last few years in that sector. And so, we've created confidence in the market that we can deliver there. I mean, once again, we're dealing in kind of the smaller side of the market here, the kind of sub 30 million pound loans, which aren't that small in South African terms. But in the UK, the big asset managers are targeting, loans over 100 million. So there's kind of this gap with like sizable loans for us that aren't sort of as big for the the sort of big players in the market. And so it's really that focus that it kind of feeds back in a loop, that sort of the market has confidence you've delivered because you've consistently said, this is what you're focusing on, this is what you're doing. And on the other side of it, when we're looking at loans, we can reference all the borrowers that we're lending to off other borrowers we've worked with. So we think we can price that risk a lot better, and kind of it loops back in a circle. And that's the benefit of staying very focused in a market.
And your client base, your funders, are they mostly South African, given your heritage?
They are mostly South African linked, we call it. They tend to be wealth managers and kind of insurance type companies and individuals, all largely linked to South Africa. They may not necessarily live in South Africa, but certainly tied to South Africa. That's definitely most of the capital. That's kind of led by the distribution team, which itself sits in South Africa, and they can lead most of the capital raising from there. So definitely has a South African focus.
It sounds a little bit like Investec in a way. When they first went, 40 years ago into the UK, they relied heavily on their South African heritage and their South African clients before moving out into getting more UK clients. Is this a pathway that Westbrook has been following as well?
I think once again, so our very deep networks in South Africa with Westbrook, the distribution team sits there. They know they have a lot of trust in that market. Sort of Westbrook itself has a strong South African business that has built a lot of trust there. So I think that made sense to kind of use that base to shift to the UK. I think what we focus on the UK perspective on the deal side in particular is really like building the ground up base, and not sort of having one foot in South Africa and trying to apply, looking at South Africa's real estate market and using it as a perfect proxy for the UK. We take kind of thematic learnings around volatility and income-based lending and things like that. But I think where some South African funders have got unstuck in the UK is that they're too high level and sort of aren't as much in the details. So we've spent in our real estate team, I'm the only South African in that team, for instance. You've got sort of British folks there who really understand the market. They know sort of every street of London, that kind of stuff. That to make sure that you're not the ones who have less information in a transaction, and actually the opposite. Back to the focus point, that we have more information in a transaction than other lenders in that market.
And where do you mostly lend to? Give us a sense from the South African investors who I know, and I've spoken to colleagues of yours in the past, you delivering a very high return, just sub double figures in pounds every year, and you can update us on that in case there's been a change there. But where is it that you would be focusing your attention to ensure that you have that information edge?
Well, as I said, it really starts from we don't sort of pick a sector and just go after that. I think that's part of the cookie cutter approach that can get you into trouble. We tend to sort of underwrite every single loan from first principles, firstly understanding who you're lending to. That's a massive part of it. What is their track record? Have we referenced them with other parties? Do they have good character? The kind of assets themselves, are they highly liquid? Are they high quality? And then the underlying cash flows, are they from strong, what they call covenants here, which would be a tenant, or are they kind of weaker covenants? Oh, sorry about that. Just lost the light. Or are they weaker covenants? So that's kind of our approach at Westbrook, which we consistently apply on every single loan. And then it's kind of the actual spread. We will look at which sectors. We don't want the whole portfolio focusing on one sector, but we have, for instance, done a few deals in the office sector, which, while unloved in kind of the macro world, if you underwrite to them on the new assumptions with new valuations, a strong reason for being in those assets, they've got new tenants, then there's still the whole sector's not going away. So we've done some there. We've got some retail. Once again, similar story. As long as there's a strong reason for being, very high footfall, we tend to like those. And then warehousing, residential, some leisure assets, which tend to have long income streams attached to them. So there's quite a spread around the real estate sectors. What we don't do is like lend on land, or we don't do development finance at all either, which has, is sort of very aggressively priced by the market, and we don't think offers sort of good risk reward.
So, James, if I understand correctly, you put the person who's or the company that's borrowing from you at the center of your universe from the lending side. You go out, find the right borrower, and then as far as the investor's concerned, the South African who's putting money into UK real estate through Westbrook, in particular the debt, can you update us on the latest numbers, the kind of returns they have been enjoying?
Yeah, so the fund, Westbrook Yield Plus, which investors invest into, which I largely look after, that has, as you said, targets a cash plus 4 to 6% return. Cash is defined as the Bank of England base rate, which is currently 4.75%, and it's largely delivered within that band. But typically, historically, we did sort of 9%. We haven't had a down quarter in the past, so the philosophy of that fund is to offer a very diversified portfolio of real estate loans, diversified both against cash flows, against location in the UK and asset class, and earn a consistent return with a very low capital loss risk. And that's largely what it's delivered over the last kind of 8 years.
And typically the kind of individual, now you did say earlier that there were institutions and companies that would invest through Westbrook, but the kind of individual who would find this useful to have in their portfolio?
Well, it's anyone who's looking for a above cash return. Obviously, investors, they have to assess the balance of their portfolio and their makeup. But in terms of having direct real estate exposure, you can either go and buy buildings, or you can buy equity in REITs or things like that. But on the actual debt side, looking at this, a lovely way to get exposure to income-based loans, so a diverse portfolio of that offers sort of cash plus return. So you're still in the low risk bucket of your portfolio, but you're getting an uptick on purely government type bonds, while not taking extreme volatility risk and things like that. All our loans, of course, have the attribute of having a fixed rate of return and having sort of low risk to go with that. So you're not looking for uncapped upside in this, but at the same time, you're not going to have every few years a big loss and you lose a whole bunch of money. So it's kind of that blend of someone who wants a safe, relatively safe return, but also you want a bit of yield pickup relative to government bonds or corporate bonds.
And critically, from a South African perspective, it is paid in hard currency. It is paid in pounds. James Lightbody is the head of real estate at Westbrook UK. I'm Alec Hogg from biznews.com.